Why your investment strategy needs a 2026 update. For the past decade, the formula for most investors was remarkably simple. Buy the dip. Stay invested. Time in the market beats timing the market. And it worked. Spectacularly. A passive approach built enormous wealth. Mega-cap U.S. stocks carried portfolios higher. Liquidity was abundant. Interest rates were near zero. Risk was rewarded. But 2026 is not 2016. The environment has fundamentally changed. And if you are still using the old playbook, you may not just be missing opportunities. You may be exposing your portfolio to risks you don't even realize are there. This isn't about panic. It's about adaptation. We are entering a new regime defined by structural changes in how capital flows globally. We are entering a new regime defined by higher structural interest rates and global growth divergence. Massive capital spending cycles and technological disruption are happening on a scale we haven't seen in decades. The set-it-and-forget-it strategy is no longer enough. Many investors today believe they are diversified, but in reality, they are heavily concentrated in a small group of U.S. mega-cap stocks. Your portfolio might look diversified on paper, but structurally, it may be more concentrated than you think. This often happens through index funds, without investors fully appreciating the exposure. The good news? This new environment is not a threat. It's an opportunity, but only for those willing to adjust. In this video, we're going to break down 3 strategic shifts you need to make in 2026. These shifts will help protect your capital and position you for the next cycle of growth. Shift number 1. Move from AI hype to AI infrastructure. Artificial intelligence has dominated markets. The first phase was speculation, narrative-driven moves, and massive price momentum. But 2026 is no longer about hype. It's about infrastructure. The hyperscalers are in a full-scale infrastructure race. Capital expenditures are projected to exceed $600 billion this year alone. This is real industrial-scale spending. A massive portion of that is directed toward data centers, GPUs, servers, networking equipment, and power systems. It is happening now. If you want to position intelligently, you need to think in layers. First layer, the cloud giants. These companies are not just software platforms anymore. They are infrastructure operators with strong revenue visibility and pricing power. Second layer, semiconductors and networking. While one company tends to dominate headlines, the opportunity is broader. AI requires specialized chips, advanced packaging, and memory. But this segment is cyclical. Selectivity matters. Not every semiconductor stock benefits equally. Third layer, and this is where many investors are underexposed, power infrastructure. AI data centers consume extraordinary amounts of electricity. That means grid expansion, energy management, and power generation. This is the picks and shovels trade of the AI cycle. The S&P 500 is already over 30% tech, yet many portfolios remain underweight in the actual infrastructure layer driving the next phase. That gap between perception and positioning is opportunity. Shift number 2, make income the anchor again. For years, yield didn't matter. When interest rates were near zero, investors chased growth. Cash was dead money. Bonds were boring. That world has changed. With rates elevated, income is returning as a core portfolio driver. Trillions in money market funds will soon need a new home. If rates begin to move lower, capital will rotate. Locking in attractive yields now provides income generation and portfolio stability. High-quality fixed income can serve as an anchor, providing predictable cash flow and dampening volatility. Where should investors look? High-quality municipal bonds, emerging market debt, and securitized credit, including mortgage-backed securities. And high-quality dividend equities, companies with strong free cash flow, pricing power, and consistent payout growth. Income provides flexibility. The macro backdrop in 2026 is not recessionary collapse. It's moderating growth with easing financial conditions. That creates a constructive environment. In volatile regimes, optionality matters. Shift number 3, break the mega cap concentration. This is the most urgent shift. Over the last decade, U.S. mega-cap stocks dominated returns. Passive index strategies naturally increased exposure. Today, a handful of stocks represent an outsized portion of major indices. Concentration risk builds slowly, and unwinding can be abrupt. So where is diversification most compelling in 2026? Emerging markets. For years, they were overlooked and underperforming. But the setup is changing. First, valuation. Emerging market equities trade at materially lower forward multiples compared to developed markets. The discount is historically wide. Second, currency dynamics. An easing Federal Reserve often leads to a softer U.S. dollar, which historically benefits emerging market capital flows. Third, structural growth. Manufacturing is expanding beyond China. Mexico, India, Indonesia, and Vietnam are benefiting from nearshoring. India is projected to grow between 6% and 7%. South Korea and Taiwan remain essential to global semiconductor supply chains. Mexico benefits from North American manufacturing realignment. Brazil is seeing improving macro stability and commodity leverage. The ex-China approach allows diversification across high-growth regions while mitigating country-specific risks. Diversification is about balance. The next decade will likely not mirror the last one. Portfolio construction must reflect that. The big picture is clear. 2026 is defined by higher structural capital costs, global growth dispersion, and AI-driven industrial cycles. The rules are evolving. Shift your AI strategy to infrastructure. Reintroduce income as an anchor. Reduce concentration risk beyond U.S. megacaps. Adapt early. The goal isn't to predict every move. It's to build resilience. In transitional periods, early adapters position for the next wave of compounding. In 2026, that wave will not look like the last one. Is your portfolio ready? See you in the next deep dive.